Good, Jesse. Okay. Now, you can use this worksheet to calculate the employee's automobile benefit that you must report on T4 or T4A sleep. T4A sleep is basically with the retirement. I'm listening, ma'am. That's good. You can also use the total benefit taxable in step 3 on page 2 of this worksheet to estimate the employee's taxable automobile benefit. That's what we are talking about. So, for the information about the automobile benefit, we need to go to Canada Payroll or see guide this and allowances. You can also use an online calculator. So, they give you some kind of guidelines if you want to calculate it. Details about the employee, last name, first name, SIN number, and address. So for calculating, as I said, there are two type of expenses. Now, because you are using employer's car, suppose you're working in XYZ Limited. So XYZ Limited has given their car to you to use it for your personal purposes. So employer will calculate all this for you, that how much benefit you are using it. Okay. So there will be a standby charge. There's a fixed cost of the usage of the car. Okay. And the operating cost. Now, what is included in the operating cost? Operating cost, I will mention it when we talk about it. But at the moment, we are talking about the standby charges. Okay. Well, operating cost is basically the gas expenses like the fuel, maintenance charge, repair expenses, insurance, license number, but it does not include interest, capital cost allowances, lease cost, parking cost, highway or bridge tolls. So whatever expenses included in the operating cost, they are also to be calculated. Okay. So we will work on the standby charge at this moment. Complete this step if you provide your employee with an automobile for their personal use. For their personal use. Okay, guys, be mindful about it. Not for employment purpose, but for their personal use. There are two methods which can be used: simplified calculation and detailed calculation. Generally, simplified calculation can only be used if it satisfies all the condition mentioned. So use this calculation if of all the of if all of the following conditions applies. Automobile you provide your employees owned by you. That means you have not leased the employee. Like suppose XYZ Limited have given you the car to use for your personal use. Okay. But XYZ Limited does not own that car. They have leased it from other company. In that case, you cannot use this method. Employee use the same automobile throughout the year. Employee's principal source of employment is not selling or leasing automobile. That means I am working somewhere. If my employer is giving me, if I'm having a two job, okay, or a one job, okay, whatever be it, but wherever I'm working, that employer is not into the business of selling or leasing automobiles. The employee is not eligible for a reduced standby charge. So they have certain percentage. They are not eligible if they don't fulfill certain conditions. Okay, Jesse. So this is something which is very important. If you fulfill all these conditions, if the person who is actually calculating, the employer anyways, if the employer knows that if all the conditions are fulfilled, they can just put the amount here, cost of the automobile, and calculate a 24% directly they have given it, put it into step 1, okay? Or maybe the one number. Enter the amount the employee reimbursed for the standby charge. So there will be certain amount will employee will reimburse it. Like I will say, okay, you have given me the car to use for my personal use, but I want to give you certain amount as a reimbursement. Okay. So if you are the amount employee reimbursed means if I give some amount, if there is a charge of like suppose $5,000, and if I reimburse $1,000, so in that case my liability for tax purpose is just 4,000. So I will just put here $1,000. And then standby charge benefit is after deducting step 1 and from step 2, and you come to A. And that's something which is the benefit what you are going to get it, and which will be added up as a taxable benefit and added up along with the operational benefit into your taxable income. Okay, in T4. If simplified calculation is not applicable because you does not or the following conditions are not met, you have to use the detailed calculations. I've given you the problems for the detailed calculations because simplified is quite straightforward. So we will be doing the detailed calculations in some time. Okay, the morning hours itself, so that afternoon we can continue reading it. So now detailed calculation. What does the detailed calculation says? So detailed calculation says that the number of days automobile was available to the employee for the entire calendar year. So now in detailed calculation, you have to calculate the number of days. If it is a month, because they are just trying to calculate in the month, right? 20 days divided by 30 days. So it's 0.61. You have to do it a round off, okay? So 130 days divided by 30. So it's like 4 months. Yeah. So they are just rounding off. Yeah. So in that case, you are calculating how many days it is available for your personal use into months. Then there is a reduced standby charge percentage to be calculated if you fulfill all the condition. Calculate the standby charge at a reduced rate. Guys, who is this? Emmanuel has entered. Who is Emmanuel, guys? Anybody who knows? For this meeting, who is Emmanuel? Maybe I'll just admit it.
Maybe new.
I don't know, because the new person is just one person. I haven't even sent that person the.
Then maybe Eman.
Who is that? No, Emma. No.
Maybe using a different name. I don't know.
Okay, maybe, yeah, I know. So I've just accepted. So we'll get to know who's that. Maybe who Filipino guy?
Not me.
Okay, now don't write it. Okay, we'll ask that person. He or she is already there. Okay, anyways. So reduced standby charge. Okay, let me ask quickly. I don't know. I'm quite curious. Let me ask quickly. Okay. Where's the chat?
Hi. Morning.
Hi, Catherine. Is you?
Yes, it is me.
So which name did you end in? No, that is
because
No, that's Catherine.
sometimes my kids using the Zoom for their school online thing.
Okay.
So I have Zoom as well. So but I changed it already.
Okay, that's good. We were just not sure, and I was not ready to accept it just because it's a new name.
Filipino guy.
The Filipino guy. So Catherine is the Filipino guy.
Yeah, right. Yeah.
It's my
Her name.
it's my son Emmanuel Christian. Because sometimes they're using Zoom to talk to their teacher. That's why.
Ah, yeah, right. Good,
Yeah.
you use.
Noor, where are you? In Mexico?
Mexico. Assalamualaikum, Mudir. Alhamdulillah.
Cancun.
Cancun.
Yes. We're going back. Yeah, we were there last.
Nice background. Oh my God. It's
Last
very nice.
2016, before my daughter getting married.
Okay, all done now?
Yeah.
Eleanor, done?
Oh yeah, I'm done cooking.
You done talking?
Yeah.
Who is coughing?
Oh my God.
Excuse me.
Honey.
Honey.
Not Corona. No, I'm.
Corona.
Did you get the test? Did you get the test done? How do you know that?
No. That's my own Corona smoke.
No, we are kidding. Yeah. No, don't worry. But if you feel, you can mute yourself. Okay.
So yeah, sure. Thank you.
Okay, thank you. Okay, so you are added up as a Samson. Guys, put your own name itself if you can. It gets easy for me to identify, right? You know. So, okay, fine, guys. So we were talking about the standby charge. So first method, if they want to use to calculate the automobile benefits, is the simplified calculation or the detailed calculation. Now, if you want to use the detailed calculation, you can use the reduced standby charge. If you fulfill all the conditions of the reduced charge, means you have to pay a little lesser. You require your employee to use automobile to perform the duties. The employee uses the automobile more than 50% of the time for business purpose. The kilometers for personal use does not exceed 1,667 per 30 days period or a total of 20,004 kilometers a year. So if you fulfill all the conditions, you will be able to calculate the reduced standby charge, and you will be able to calculate the detailed calculations. Okay. Now for detailed calculation, it's very easy. Like you just have to calculate the amount. If first one, employer owns the automobile. If employer owns the automobile, cost of the automobile generally equals to its fair market value at the time of acquisition, including GST, HST or TST. Just put that amount here, 2%, and that's the amount. Okay. If employer leases the automobile, enter the monthly leasing cost, well, which is the total cost including the down payment divided by the number of months. So that's the 2/3. Okay. If employee sells or leases the automobile, means if employer's main source of employment is selling or leasing the automobile, then there is another method of calculation, which is into 1 times 1.5%. Now that is just the amount of standby charge. However, you have to include the reducing standby charge. So this is the calculation. This is a formula, you use it. Amount which we got it from 1, 2, 3, 4 or 5. That means if you see step 3, 4 or 5. And the number of days automobile is available to employee. That is, if it is a yearly, then just put the month. If it days, then you have to convert into month. Divide into times personal kilometers. Divide by if it is monthly or yearly, how many kilometers is driven, and that's the amount. Any amount which is reimbursed by the employee, and that's the amount of standby charge. Do not panic. It's okay if you're going to calculate it, and it's going to be super easy when you calculate it. Okay. Looks hard or looks more bigger. Okay. Second is the operating benefits. Now that's a standby charge calculation. A standby charge calculation is already given, so you don't have to think about or by heart the formula. Just have to use the formula or the sheet and calculate it. An operating benefit. Now operating expense benefit is where you can get the benefit for the personal use. You can get some gas expenses, maintenance expenses, license renewal expenses. So these are the expenses which you get it from the employer. In that case, you use either of the two methods. Okay, whichever is lesser, you add up. Okay. So complete this step if you provide an automobile to your employee and pay for operating expenses related to personal. If your employee reimburses you all operating expenses attributed to personal use no later than 45 days after the end of the year, do not calculate an operating expense benefit. So suppose if I am using a automobile which my employer gave me for my personal use, okay, and my employer I incur, or my employer already gave me some amount, okay, that I can spend this on my automobile operating expenses like gas and maintenance. But then I give it within 45 days that amount back, then it is not included in my taxable benefit. Unless until it is not given within 45 days, fully or partially. So if it is not given, then you have to use this formula, or you can use both and just calculate which is the lower of it, okay? So the employee does not reimburse or only partially reimburse you for the operating expenses attributable to personal use no later than 45 days after the end of the year. The employee did not elect to use the optional calculation. The employee occupies any employment other than selling or leasing automobile. So if he uses more than 50% of the time this, and if it is not in the selling or leasing, you just use this formula, personal kilometers, how much is driven into 28 cents. That's the amount which you calculated. If employer's principal source of employee selling or leasing, then just use this amount into 25 cents and that's it. Or fixed rate for 2019, okay, or optional calculation. This calculation may not be beneficial in all cases. However, you have to calculate both, look which is lesser and just try to calculate it. Now use this calculation if both of the following condition applies. The employee uses the automobile more than 50% in the course of their office or employment. The employee requests that you use this method. So standby charge which we calculated before, if any employer investment times 50%, that's it, and that's the amount is. So whichever is lesser, you use the operating benefit. And then there are certain thing, if you reimburse it, if there is any other party reimbursing it, so you just add up this. So total taxable benefit is adding up both A and C or B and C. That is a standby charge and the operating benefit. Now, this amount is a taxable benefit. See, listen to it carefully. Okay, this amount is a taxable benefit. You report in box 14. It's the employer. Okay. And in the other information area under code 34 of the employee's T4 slip, or if applicable, use code 28 other income at the bottom of the T4A slip. So this is something which you are going to use it in the T4 slip if you provide it as a benefit. We'll be doing problems in some time. Maybe now or after break, we'll see how it goes. We're going with the flow, so let's finish the reading part, some of the reading part. Okay, but I will get you back to this this sheet. So this is not a super difficult thing. Okay. Now, so that was all about. If you see this fixed cost, variable cost, amount reduced by employee payment, that is a reimbursement made by the employee. Less than 50%, if you see 2%, employee leases the cars, 2/3. It's already given. This formula is already given into the sheet. So you don't have to by heart it or think about it. This is also given. Standby charge reduction primarily for employment usage. Okay. And how many kilometers is driven. Less than 50%, 28 cents. Okay. Primarily employment usage. So that's something which is very important. Mohammed always get up very late and come at 11 o'clock almost. Okay, so that was all about the automobile benefits which an employer can offer it. There are many other clauses as well. Even the employer can sometimes provide a flat rate, rather than the kilometer base, they just give you flat amount, okay? But this is the amount. Sometimes they give a mix of both flat amount and the number of kilometers driven. So accordingly, the amount is calculated in the automobile benefits. And that's all about the automobile benefit. We'll do the problem, whatever I have given you the questions. Work over it in some time. Okay, so that's all about the automobile benefits which an employer provides it, and it's added up in the text T4. Okay, other taxable benefit includes board and lodging. Suppose if an employer gives an employee board and lodging, which means that he provides him with her accommodation and in some cases food as well. So if you provide free lodging or free boarding and lodging to an employee receives a taxable benefit. As a result, the employer will add up the fair market value of the boarding and lodging, okay, in the T4 slip and in the other information section below as well. So if it is a subsidized boarding or lodging, they will mention the subsidized rate, whatever is there, okay? So as a result, employee salary will be including the fair market value and the lodging you provided, okay, minus any amount employee paid. So if you provide any boarding or lodging, Mohammed, you got to come a little early, okay? It's very late nowadays.
Sorry.
Since the past weekend, you're coming late, so please make sure you come on time, at least by 9:30.
Sure.
Okay, thank you. So, so boarding and lodging also you get it as a taxable benefit. Now you can, so there are certain situations where that can affect the value of taxable benefits. So boarding and lodging has some exceptions. Okay, guys. So if you provide boarding and lodging to player on a sports team or a member of recreation, so there are certain exceptions. Even if you provide boarding and lodging to the employee who work as a special site or a remote location, how are you going to deal with that? Now, if boarding and lodging is provided to the employee who are like a player on sports team or a member of recreation program, then there are certain amount which you can exclude it. You don't have to consider it as a taxable benefit. You consider it as a part of the employment. You can exclude an amount of $366 per month from the income for a board and lodging allowances. Okay. Now, boarding and lodging for a special work site, we focus on that and a remote location. Well, it is very possible that if employee has to work to a location that is both a special work site and a remote work location, so the benefit can only be excluded from employee's income once. Okay? So if a special work site is there, like there is a special work site which is like an area where an employer has to work, like, for temporary duties by who keeps like who is away from their personal residence, okay, where he regularly lives, or a principal residence. So in that case, what happen is, uh, usually boarding and lodging on the work site. So you can exclude from the income the value of boarding and lodging or allowances you provided to an employee who works in a special work site if the following conditions are met. Okay. Employees duties required. Going. Wait, give me a second. I don't know why it's echoing. I think there's somebody else talking as well. Is it still echoing? No. Okay. Well, so boarding and lodging is like if you work on a special work site, if you fulfill the following condition, then in that case, it is not considered as a taxable benefit. So what are the special work site? So in that case, the employee's duty required him or her to be away from the principal residence. The employee had to work at a special work site where the duties performed were of temporary nature. Employees kept at another location, a self-contained domestic establishment as a principal place of residence. Boarding and lodging or allowances for a boarding and lodging you provide to the employee have to be for a period for at least 36 hours. So this period can include the time spent traveling between the employee's principal place of residence and special work site. So this all, if you fulfill it, it is considered to be a special work site and it's a part of employment and it's not considered as a fringe benefit. And in that case, you don't, even if you provide allowance to them, it is not considered as a taxable benefit and you don't add it up in your T4. Even if you are working in a, and then you have to sign a TD4 documentation, okay, where you say declaration of exemption. So if you refer to it, you'll get an idea. Remote work location. Even if you work in the remote work location, that is like a remote when it is 80 kilometers or more from the nearest establishment, in that case, and where there is just a population of 1,000 people, so that is considered to be a remote work location. So a location is considered an established community if an essential services are provided within a reasonable community distance, like basic food. We know nowadays we know very well what are the essential communities: basic food, basic clothing, accommodation, medical services, educational facilities. Give me a second. There's somebody who's written. Yeah. Well, MD, I'll talk to you later on about it. Okay. Maybe after we finish this, so we can just But I'll just keep that in mind. Let me just continue this first. Okay. Okay. So basic. If it is a remote work location, so if you live from like 80 kilometers away and there is only 1,000 people and there are not established communities, in that case, you can exclude from the income the value of boarding and lodging or an allowances for boarding and lodging that you provide to an employee who works at remote work location. So now, guys, there's some noise coming. Can you please not make noise? There's some cooking or some noise coming. Please mute yourself. That's okay. Okay. Mute everyone, in fact. If you want to talk, you can unmute yourself. Okay. I've muted everyone. So you can exclude the income. So if all the conditions are met, it means that you're working in a remote location. And in that case, you are not meant to report that amount in the T4. Rather, your employer will, and you have to sign a TD4, declaration of exemption. So employer could not reasonably be expected to set up and maintain his own principal residence and distance from established community. And employer did not provide a residential house for employee. The boarding and lodging or allowances for boarding and lodging were just period for lasted 36 hours. When one of the following situation applied, employee had to be away from the principal place of residence because of their duties. Employee had to be at the remote location. So in all these cases, if the conditions are met, then the boarding or lodging is provided for not for the personal purposes or personal enjoyment purposes, but is considered as a work related. So if anything is provided for the work related, then that is, and any allowances is provided for the work related, that's not considered to be fringe benefit, and they are not considered to be taxable benefit. So that will not be included in T4. Okay. Now, when they are not included in T4, you have to exclude the deductions from payroll as well. So you don't deduct the CPP, you don't deduct the EI premium or income tax as well. Okay. So be mindful about that, guys. Next is cellular phone and internet benefits. So if employer provides employee with a cell phone or other communication device that employer is owning to help carry out the employment duties, the fair market value of the cell phone or device is not the taxable benefit because you are using it for the employment purpose, not for your personal purposes, right? However, if you are giving some money as a reimbursement to your employee, like if employer gives some money as a reimbursement to the employee for cost of their own cell phone, the fair market value of the cell phone or device is considered a taxable benefit to the employee. You know what? Now what happens is if employer gives you the phone, okay, to talk to phone, like suppose you're working and at workplace, if employer says, oh, you can use work phone and work. I know my husband uses work phone all the time and he has to call up or he has to talk for the work purposes, but he doesn't get that mobile phone at home. So in that case, it's not considered to be an employment benefit. But suppose if your employer pays you the money, then you buy your own phone, but with that phone you use employment work as well, and you can use your personal stuff as well. So in that case, to the extent you are using it for the personal purposes, your amount will be deducted as a taxable benefit, and the purchase price of the phone is also amount is reimbursed, and that is used as a taxable benefit. Now, if you pay for or reimburse the cost of employee's cell phone or internet at the home to help carry out employment duties, the portion used for the employment purpose is not a taxable benefit, as I mentioned it, right? If the part of the use of the cell phone or internet is personal, you have to include the value of personal use in your employee's income as a taxable benefit. So that will be mentioned in T4. Okay. For cellular purpose phone, we do not consider your employee's personal phone use of cellular phone service to be a taxable benefit if the plan cost is reasonable. And if your plan is a basic with fixed cost and your employee's personal use of service does not result into charges that more than the basic plan. So if you have actually given you, if like, you know, you have given some kind of benefits in terms of if you give you the services, the phone services, right? Like we use Fido or we use whatever, you know, what TELUS or some other kind of network connection. Okay. If your employer just provide you the basic plan, okay, which is just reasonable plan, in that case, even if you use for your personal purposes, they don't consider it as a taxable benefit and it is not added up in your T4. Okay. Now, next is the employer provided childcare. Suppose childcare is not taxable if all of the following conditions are met. Services are provided at your place of business. Services are managed directly. So if you have your child and you take at your workplace along with you, and services, basically childcare services are provided by your employer. Okay, they take care if they are having their own business or that is managed by your business itself. Okay, in that case, it's not a taxable benefit. However, if when you arrange for a childcare, like suppose you're working with some employer, you're working with TELUS, and TELUS says, okay, you know what, we will help you to get a subsidized rate of childcare amount. Okay, so we have a tie-up with some childcare. So what you can do is like you can get your child use that childcare for your child and at a subsidized rate. So the amount which is the difference between the actual amount and the subsidized rate. Suppose, for example, if the childcare amount is $300 for a particular period of time, and cost is that, and employer says we will just get you into for $150. So the balance of $150 will be the taxable benefit. It will be added in your income, and it will be deducted as a taxable benefit in your T4. Okay, so that's what is the childcare benefit they provided to you. Disability related employment benefit. if you provide disability or allowances to an employee. Sorry, guys. Oh, disability related employment benefit. If you provide benefit or allowances to an employee who has a disability, such as transportation cost or attendance services, they may not be taxable. Reasonable transportation costs between employee's home and work location are not taxable if you pay them for an employee to whom they're legally blind or has a severe and prolonged mobility impairment. So in this case, they are not considered to be a taxable benefit. Okay. Next is discount on employer merchandise. Now, if you sell merchandise, the goods to your employee at a discount rate, the benefit they get from this is not usually considered as a taxable benefit. Like suppose, for example, if an employer is selling goods to employee, okay, at a discounted rate, they get from this is not usually considered at a taxable benefit. But okay, Jesse, thanks for informing. Okay, so suppose, for example, there are certain conditions where if you provide the discount to the employee, they are considered to be a taxable benefit. Okay, suppose if employer make a special arrangement with an employee or a group of employee that they will buy the merchandise at a discounted rate. This is just a special arrangement. Okay, in that case, it's considered as a taxable benefit. But if it is normal discount, and if you are selling the goods to your employee at a discounted rate, then it is not considered as a taxable benefit. If employer makes a special arrangement that allows an employee to buy merchandise that is the latest merchandise at a lesser cost, in that case, it's considered as a taxable benefit. Now, suppose Winners has come up with a new latest product, okay, which is not at all on discount. But if Winners says that all employees will get the goods, the latest goods or the latest product, okay, at a discounted rate, so the difference between the actual price and the discounted price, okay, will be the taxable benefit, which will be included in the T4. Even when you make a reciprocal, when employer make a reciprocal arrangement with one or more employer, so that employee of one employer can buy merchandise at a discount from another employer. Now, suppose if I'm working in Winners, okay, and Eleanor is working in super shoppers, okay, sorry, superstore. Sorry, my bad, okay. And employer in Winners say that, okay, Eleanor is working in superstore. Now, employer of Winner and the employer of superstore, like Winners and superstore, both tie up with each other, and they said that my employee can buy discounted goods from your place, and your employer can buy the discounted place. So this is considered to be a taxable benefit. Okay. Why is my screen still in vehicle tax application sheet? I don't see that you are reading. Okay. Guys, can you see the PowerPoint presentation? Okay, well then I'll just take you guys. Okay, give me a second, Eleanor. Sorry, not Eleanor, Janet. Okay, can you see now? Yeah, I think you can see. Like, let me unmute you so that you can unmute yourself. Can you see now?
Yes, ma'am. Yes, Miss Fatima.
Yes.
Now it's
Okay,
the
good. Rex,
PowerPoint.
can you see now, Rex?
Yes, now it's the PowerPoint.
PowerPoint.
Siyempre, Iyan.
Who is that? This is making so
Yun
much of
yung
noise.
ang sabi ko kay kuya mo. Sabi niya,
For
Mercy.
Mercy.
Mercy. I think I have said Mercy, right? Many a times.
Oh.
But let me see.
Ngayon, ang sabi niya, siya lang ang sisira, kawawa naman siya.
Okay.
Mercy.
Oh, no.
Mercy.
Commercial.
Unmute Mercy. Commercial.
Free commercial.
Oh gosh. Mercy, I have mute and I have muted Esther as well. Sorry, there's so much of noise coming on. Despite of telling so many times, it's really sad part, that you have to keep telling all the time. Yeah, guys, if it is a classroom, we can try managing it, but it's so difficult to manage in this way. So, and I'm giving you the power to just mute and unmute. Why can't you use it? And that's the saddest part. And I want it to be more like a classroom, so I wanted you to handle it. So if you want to say something, it's easy rather than you putting it on chat, I just answered it. It's Mercy who's talking. Oh, sorry, Esther, then. Sorry, my bad. Sorry, but I've muted you, but you can unmute if you want to talk, okay? I've given you the power. Sorry, guys. Because we have lots to do, and if we keep wasting time this way, it's going to be difficult. That's the only my concern, Thanks, Esther. Okay, so if you have a discount, so for example, if I have if winners and shoppers have superstore have a tie-up that winners employer says that winner says that my employee will get a discount if they buy it from superstore, and superstore employee says, so in that case, whatever discount you get it because of the deal between two employer, reciprocal deal between the employer. In that case, you are eligible for the taxable benefit. That amount is eligible for the taxable benefit. Education related benefit. If you provide education related benefit. Okay, Rex and Janet, can you see the screen now? If not, do let me know. Otherwise, it's all fine.
Yes.
Okay, good. Thanks for letting me know. Okay, education benefits. So if you provide education benefits to your employee, like if employer provides education benefit to their employee, it may not be taxable to the employee in certain circumstances. Like suppose, for example, if employer provides education benefit to person other than employee, such as employee's family member, or which is where you do not have to include the value of benefit in the employee's income as long as you deal with the arm's length. Like if you have any other family member with him whom you are giving the employee the benefit, employee's family member the benefit, in that case you're not including it into the employee's income because you're not dealing with the employee's family member. You are dealing with the employee's family member at arm's length, like you have a business with them that you provide this, if I give you this course or something like that. In that case, it's not considered to be a taxable benefit. Even if you pay an amount to an employee as an educational allowances for employee's child, and if employee has moved to a place, they live in a specific location for the work purpose away from home, and they do not have a good educational system out there, and they need to meet certain of educational needs, and they have to go to a particular school which is a little bit far off, so they provide some employment allowances, educational allowances. In that case, it's not considered to be a taxable benefit. However, if in the normal situation, if an employer provides amount to the employee as an educational allowances for employee's child, in that case, employees it will be included in employees' income, okay, as a taxable benefit. So there are certain different situations in which you need to understand it. Now there are subsidized schools, okay. So if there is a good school, so employer has some tie-up with that school. So if employer provide the subsidized school services in the remote area, employers are often responsible for essential communities and services. So if you provide free or subsidized school services in remote area for your employees' children, the employee does not receive a taxable benefit, okay, because he anyways is working it in a remote area and you're providing a subsidized benefit. So you don't have to include in the CPP, EI or income tax deductions. So that's something which is talking about the employees, okay. Gift. Now, there is something called as gift, awards, and long service awards. So, gift or award that you give an employee is a taxable benefit from employment. Now, gift. Don't understand who's that. Okay, a gift or a award that you give to an employee is a taxable benefit. Whether the gift is a cash, a non-cash, or a near-cash benefit. However, cash and near cash benefits are always taxable, okay? Non-cash can sometimes not be taxable benefit, but cash benefits or a near cash benefits are always taxable benefit which are offered to the employee. Now, what is near cash benefit, guys? What is a near cash gift or near cash gift? Near cash gift is it's like function as a gift card which can be used like a cash, right? So you can buy anything from a particular store, so that's called a near cash. So which can be converted, or an item which can easily be converted into cash, like suppose gold or a security or a stock. So they are considered to be a near cash. However, non-cash is something is they directly gives you goods or services. Okay, so in that case, you can convert that into that cannot be converted into cash. So that's something which is different. Now there are rules for gift and awards. A gift is generally given for a special occasion such as religious, holiday, a birthday, a wedding, or a birth of a child. While award has to be for an employment related accomplishment such as outstanding service or employee suggestions. Well, it is a recognition to the employee's overall contribution to the workplace, not recognition of job performance. So generally a valid non-taxable award has clearly defined criteria. So if it's an award with a clearly defined criteria like I have mentioned it, then it's not considered to be a taxable benefit. However, an award given to your employee for performance related reason, like they have performed very good in the job um, that you were hired and exceeding production standards, completing project head. So a specific small individual task. Okay, in that case, that is considered to be a reward and it is taxable benefit. So if you give your employer, like if employer give their employee a non-cash gift or award for any other reason, okay, that the policy does not apply and you have to into the fair market value of the gift or award in the employee's income. Basically, what is the policy of the non-cash gift and award? You may give an employee an unlimited number of non-cash gift and awards with a combined total value of $500 or less annually. Suppose if the gift or awards exceeds the amount of 500, like suppose it becomes 650 during the year, so you just have to consider the balancing amount as the balancing amount, that is $150. Okay, suppose if you are giving $600 as a gift and awards during the non-cash gift and awards to the employee, okay, during the year, so $500 is exempted, that is not taxable. However, the extra $100 what you have given, that will be considered as a taxable benefit and will be included in your employees in your employees income. However, there are certain small trivial amount you give it as a gift, okay, or goods or service you give it as a gift, they're not considered as a taxable benefit, like coffee or t-shirt with an employer's logo, mugs. You don't consider this as a employer's as a taxable benefit and you don't income. This is just a normal thing as a part, okay? So it's considered as a not considered as a taxable benefit and not included in your T4 and not CPP, no EI or no income taxes deducted. Okay, but if it is a non-cash gift and if it is exceeding during the year more than $500, okay, then the extra amount will be considered as a taxable benefit. And any cash or near cash benefit given, regardless of the amount, will be considered as a taxable benefit. Okay. Long service awards are also given to the employee. Well, in that case, if the employee is working for the 5 years, okay, and if you are planning to give them $500, an amount of $500, okay, then that is considered to be a tax-free. The award must be a minimum of 5 years service or at least 5 years. Any amount over 5 years, $500 is taxable amount, okay. However, if that person is worked for 10 years, okay, and you have if a person is worked for 10 years, so every 5 years you are giving them the benefit. Suppose if a person has completed a 5 years and then on the 6th year you decide to give them the benefit of the long service award, so you give them $500. That is not considered to be a taxable benefit. That's okay. But again, on the end of the 10th year, if you give them a $500, because you have already given in the 6th year, okay, or the ending of the 6th year, it's just 4 years considered. So you cannot give back to back unless the period is equal to 5 years. So after 5 years, if you give them a gift, even for the next 5 years, there should be a gap of 5 years of giving the gift. And it has to be $500. If it is exceeding $500, then it is considered to be a taxable benefits. Insurance. So employees gets insurance benefits from the employers. So there are term insurance. Okay. So if premiums are paid by the employer for individual, regardless of the age, gender, or benefit, so it is considered to be a taxable benefits, which includes the premium payable on the individual's life insurance policy, plus the total of sales tax, excise, excluding GST, plus any provincial insurance levies, minus any premium or any taxes that employee paid. Like out of all the insurance premium, all the expenses, if employees paid any amount balance, then that's considered to be a deducted, and the balancing amount is considered to be a taxable benefit. So yes, the insurance premium paid by the employer is also a taxable benefit, and they are added up in your in employment income. Okay. Now, next is employee loans. Sorry, guys. So we have employee loans. So if an employer provides an interest-free loan or a low-interest loan, okay, so the benefit is the amount of interest that the person would have been paid on loan for the year at the prescribed rate. So suppose if a person has got a loan at, I'm just giving an arbitrary rate. Suppose a person has got a loan at like 4%, okay, at an interest rate of 4%. And if outside, if he gets, of course, that's not the actual value. But if actually they go to get the loan, they have to pay like 10% or 7%. So the difference of the amount of the interest what they're paying, so the difference of the amount will be considered as a taxable benefit, and it will be reported in your employment income. However, loan has to be received because of the employment. Like if he would not be working in that employment, he would not have received that loan. So that is very important criteria if they receive the loan. So the loan can be received by the employer or by any other person, that is a related person. A loan can include because you have too much of debt or you want to pay the employer some money. So in that case, the interest on each loan and debt calculated at the prescribed rate of fee period in the year during which it was outstanding. So that's all the information which is given if actually you get the loan on the employment. Even sometime you get the loan for the home purchase, okay? So if you get that loan for the home purchase, so the residence has to be for the employees or the home has to be purchased for the resident of the employee, okay? So once the home purchase loan is established, you have to make the payment of the interest, okay? So what is the difference in the payment of the interest? You have to consider it as a taxable benefit. Now, once a home purchase loan is established, the prescribed interest rate is in effect for 5 years. So the amount of interest you calculate as a benefit should not be more than interest that would have been charged at the prescribed rate. So the benefit is the difference between the rate you would actually pay and you are paying right now. In that case, the difference is what you will be paying it as a taxable benefit. Even when you get the loan because of home relocation, okay, if you're moving from one place to another, okay, because of the employment purposes, in that case also it's considered to be a home location loan is a loan you give to employee or employee spouse or common law when they meet certain conditions, okay. So include amount of taxable benefit. So to calculate the benefit of home loan, you have to consider certain criteria in the CRA and have to look at the amount of interest calculated and what is the difference between the interest, that is the amount of the home relocation benefit, taxable income. Even if you have certain amount of loan which you have to pay to the employer and they forgive their loan, okay, they forgive your loan, they say okay, you don't have to pay any balancing amount because I'm okay with that. In that case also you have to it will be included in your taxable benefit because it's considered to be a taxable benefit and it will be included and deducted from your T4, okay, from a CPP, EI, everything. Loyalty and other point programs. So suppose if you are traveling to different places for business purposes, okay, but you are using your own credit card. So and then employer will reimburse you that amount, okay. Now that is all good, but when you are using your own credit card traveling for business purpose in different places, you get some air miles, you get some kind of credit points, okay. And if that amount is you can convert it into that amount what you use it. So this point can be calculated and converted into cash, right? So if you convert it into cash, this is considered to be a taxable benefit because it's considered that your employer is providing you some kind of benefit as for your personal purpose, and they are included into your income for tax purposes. So your employee do not have to include in the income the value of rewards they receive or enjoyed from the points they collect on the business trip unless any of the following apply. The points are converted to cash. The plan of arrangement between you and your employee seem to be a form of remuneration. And the plan of arrangement is for tax avoidance. So there are certain conditions need to be identified, and based on that, it is considered to be a taxable benefit. Meals. Now, sometime you provide overtime meals to your employees. So if you provide an overtime meals, it's considered to be the part of the work purpose. So in that case, it's not considered to be an employment benefit. However, if it is like and you provide the allowances you provide for the meal, okay, is like $17. This considered to be a reasonable amount, okay. And again, the amount is decided on the area where you are actually working and what is the cost of the meal. The employee works 2 or more hours of the overtime right before the work or after the work is considered to an overtime. However, the overtime needs not to be frequent. If it is a frequent overtime, and if overtime occurs frequently or become the norm, then the employer consider the overtime meals or allowances to be a taxable benefit if they provide it. Or even sometimes they provide the subsidized meal, okay, like they have their own cafe or a cafeteria in the office or in the organization or the place of work. And if they provide the basic amount an employee pay for this, it's not considered to be a taxable benefit. So that's something which is very important to be noted. Medical expenses also, if employer pay or provide an amount to pay for an employee's medical expenses during the tax year, well, they are considered to be a taxable benefit. Moving expenses also is considered to be a taxable benefit unless there are certain conditions met, okay. Moving expenses, like you're moving when you transfer an employee from one of your places of business to another. The amount you pay or reimburse the employee for certain moving expenses is usually not taxable benefit because it's for your work purposes you are moving them. So any related expenses for moving is not considered to be a taxable benefit and it's not added up. Okay. However, if it is paid by the employee, it will be considered as a taxable benefit if the employer pays and reimburse moving cost. That employer does not list the amount generally considered as a taxable benefit. If you do not reimburse only partly an employee, the employer, well, which we are not considered as the cost of housing, hunting trips to new location, including childcare, traveling cost with employees and members of employer household were moving from old residence to new residence. So these are all not considered to be the taxable benefit because this is all required to be paid just because he's or she's moving because of the work purposes. Any expenses apart from that, if it is paid by the employer, that are taxable benefit. If you pay or reimburse moving costs that do not list the above, like whatever is mentioned in the not included, then that amount is considered to be a taxable benefits. Parking. So employer provided parking is usually a taxable benefit. For an employee, if depends whether or not an employer owns the lot. The amount of benefit is based on the fair market value. However, there are certain exceptions to that. So if employee has a disability, the parking benefit is generally not taxable. There is no taxable benefit for the employee when employer provides a parking to the employee for business purpose and for the employee's regular use of their own automobile. Okay, so in that case, it's not considered as a taxable benefit. Guys, what is a pool registered pension plan? Can you just research quickly and tell me what is pool registered pension plan? I'm waiting, okay, guys? Tell me what is pool registered pension plan? Even if you want to speak, I can just unmute you. Why is Mercy?
Retirement savings
Deferred income
Kind.
individuals
provide retirement income
including self-employed individuals.
and self-employed individual not have PRPP will offer investment and savings
May 500 something yan.
cost.
May 400 something din.
PRPP is a new kind of deferred income plan designed by retirement.
To provide retirement income for employees and self-employed individuals
Income for employees and self-employed.
place.
PRPP?
Yeah, okay.
Deferred income plan.
Retirement
We do not
savings
have access to
option
it.
for individuals,
Wait.
including
Catherine, wait. I think there is some noise coming in. So I'm just trying to figure it out when I'm trying to mute them.
Okay. It's just under Canada website.
Okay, go ahead.
It is a retirement savings option for individual, including self-employed and individual. So it's a retirement saving option.
Yes,
For-
very true. PRPP is more like RRSP. So
Yeah.
it's a retirement saving options for individual where you can it's a new kind of thing which is come into picture and which has come not very long ago, and there also you can save certain amount as an investment, especially you know what this will be like more for, I think, even for the self-employed people as well. But
Yeah,
it's
self-employed.
yeah. So that's a PRPP. Now, if an employer make the contribution to PRPP, okay, in that it is considered to be a taxable benefit. I think not RPP, Romel, it's PRPP we're talking about. But anyways, thanks for adding up. So
Contribution, employee.
contribution by employer to the employee's account, you know. So,
Oh, okay.
yeah. So if there is a contribution which employer makes to PRPP for their employees, okay, so it's generally considered to be a taxable benefit under Pool Registered Plan Act and a similar provincial act, and not with the Minister of National Revenue. So if the your contribution are taxable, so employers' contribution are considered to be a taxable benefit if they are with the provincial PRPP Act or under similar provincial, but not under the Minister of National Revenue. In that case, they can be added up in the income as well as deducted from the CPP and EI and income tax. Okay.
Okay.
Next is the provincial healthcare premium as well as a private healthcare premium. So provincial healthcare premium is like you employer may be paying premiums or contributing to provincial or territorial hospital or medical care insurance plan for the employee. So in this case, the amount that is paid is considered to be a taxable benefit. Okay, and they are to be included in the T4 slip. Even for the private healthcare service, but in private healthcare service, if premium is paid, if employer make contribution to private healthcare services plan such as medical or dental for employees, there is no taxable benefits for the employees. This is not considered to be the taxable benefits. They're not considered to be the taxable benefits. It's not included in the T4, and it's not included in the T4, and it's not included in the CPP and EI. Okay. Professional membership dues. So, well, second, there is one chat. That's okay, Kathleen. I've anyways added up. That's fine. So, professional membership dues. If an employer pays professional membership dues for employee and that the primary beneficiary is the employer, like if they are adding up the employer or paying for the employer for some professional membership, okay? Like suppose CPA professional membership or any other similar kind of community which is related to the employment. So if it is for the benefits of the employment, it is not considered to be the taxable benefit. However, if it is for the personal benefit for the individual, then it's considered to be a taxable benefit, and it will be added up in the T4 or the employment income. Okay. Recreational facilities and club dues. So the use of recreational facility or club is a taxable benefit for the employee. However, there are certain situations in which it is taxable, like when employer reimburse or subsidize the cost of the membership at a recreational facility, like such as an exercise room, swimming pool, or gymnasium for the personal benefit of the employee. Even when the employer reimburse, pay or subsidize the cost of the membership to a business or professional club that is operates fitness, recreational, sports, or dining facilities. And there are other things which happens at that. There are certain other situations where recreational facilities are considered to be a taxable benefit. So, but however, if a recreational facility is just provided in-house and facility is available to all employees, so in this case, it's not considered to be a taxable benefit and not included in the T4. Next is stock options. Now, you know what happened is sometimes employer, let me just, there are certain people who does not fail to understand to mute themselves. So I have to mute them. Okay, there are certain situations where employer will provide additional amount in terms of stock options. Okay, so they provide employee with an incentive. They say that, you know what, we would like to give you a stock option as an incentive to the employer. And so they are a kind of security. Okay, I think Eleanor was mentioning last time that Superstore just does give them employee stock option, so as a compensation package. So if there is something given to an employee as a stock option offer, okay, to the employee as an incentive, as a compensation package, in that case certain amount has to be deducted as a taxable benefit. Now what amount is deducted as a taxable benefit is the amount of difference between is the difference. Well, we will be seeing in the next one of the slide. I will show you. Okay, let me go to that slide. So we will just check that, and it's easy for me to explain you. So what is stock option? Basically, stock option is defined as an option to buy shares at a specified price for a specified period of time. So it provides incentive for employees' performance. Okay. Well, there are certain situations. So there will be an offer given by the employer to the employee at a price less than the fair market value. Like whatever price you can buy it in the market, I give you at a lower price as an offer to purchase it. So suppose you buy it, so that is an offer. Okay, 5% of our bi-weekly income. Oh, okay. Okay, so that is the employment benefit you get it, right? So what happened is, like, if suppose you are getting an offer from an employer that they would like you to, if you want to buy that option, okay. So employer decides later on, and he or she says that, okay, so when it decides to buy, that is called an exercise. The option are exercised when the employee decides to buy the share. Now, when employer buys the share after a certain period in time, he or she feels that they want to sell the share. So all the amount is considered to be so there are certain discussion in this where an employer is even granted with the deductions. So suppose, for example, you can consider the stock option amount at certain situations in time. If employee accepts that share, it's considered to be an employment income and it's considered to be a taxable benefit. Now, suppose, for example, an employee, okay, look at this example. An employee receives options to purchase 100 shares at $10, okay? Like now employer is there, Superstore says that, okay, to an employee, to Eleanor, that that do you want, would you like to get as a compensation or as an additional incentive amount of 100 of shares of $10? So at that time, the fair market value is $10. That's okay, okay? $10 and $10. But now when the fair market value is a market existing in the, price existing in the market, okay? Now, when Eleanor thinks of it that she want to exercise it, when she want to buy the share, exercise means you want to buy the share. So if you want to buy the share at that time, the market price is $15, but she only have to pay $10. So she gets the benefit of $5, okay? But after some time, Eleanor feels that now she want to sell the share. So if you want to sell the share, you will sell the share at a difference between the price, fair market value when you bought it, and fair market value when you sold it. So she's selling the price at $25, but when she bought it, the fair market value is $15. So the difference she get is $10. However, she will only get half of the capital gain. That is because allowable capital losses and taxable capital gain is just 50%. Okay. Now let's see the problem. Okay. Now let me just put it this way so that Now let's see the problem. Suppose the employer is offering to buy. That's what the problem is. Employer is offering to buy an employee 100 share of $10. So that's a granting. That's a state of granting. So if you are granting an employee to buy the share, there will be no effect because employee is still not bought it. It's just the offering which is made. So there will be no effect. However, if the employee decides that she or he wants to buy the share, she exercises it. So what is the price? Price existing, if you see, price existing in the market was $15 when she decides, but she has to just pay $10. Okay. So the difference between $15 and $10 is $5. So $5 times 500 shares. So the amount of taxable benefit included in T4 will be 500. Okay. So that's the amount of benefit which an employer is given to the employee. And that's included in the T4. And on that basis, the CPP EI will be deducted. Now, employer is a public company. I mentioned here. So just be mindful about that. Now, suppose after some time, the price you get, you have the share. Now you already holding the share. Okay. Now you feel that the price is happening good and I want to sell the share. And the price they say is $25. So the price which is used to sell the share is $25. But what was the price what was the fair market value when you purchased the share? $15. So what is the profit you get it? You just use the logic of if you buy the car, okay, just normal. If you buy the car and if you sell the car, so you will always try to find it out whether you have made a loss or a profit. Suppose you buy the car of somewhere $10,000 and if you sell the car of $7,000, okay, but what is the fair market value existing? You are going to check it out, right? So that is a car. So it's a difference between a share and a car, but you are just trying to apply the logic of what was existing then and what is existing now. So you have sold the share at $25. However, the price existing when you bought the share was $15. So it's just $10 profit what you're getting it, okay? Because you are selling 100 share, okay? So you get $1,000. Now you cannot file. Taxable capital gain means, if you remember, we did in one of the first chapter that allowable capital loss and taxable capital gain are just 50%. So divide by 2. So it's going to be 500, which will be in the taxable gain. But this is not the part of the, which will not be shown in the T4. This is just for your income tax return purpose. When you are going to file the income tax return, you're going to show this amount, okay? So this is a net income for tax purpose. But we are just focusing now on this amount, 500, okay? So if it is a public company, and if your employer is granting you to, if your employer is offering you to buy or granting you an option to buy a share, and if you are agreed to buying the share, then the price what you are going to pay is the employment income, because this is a benefit, right? You're getting a benefit. This is your personal benefit. Ideally, if you go to the market and buy, you have to pay $15. But because employer is giving you a $10, you have given a benefit. So this is kind of a taxable benefit. Okay. But now you decide that you want to sell the share. So when you sell the share, it is a difference between the fair market value of the selling price minus the fair market value of when you purchase the share. Okay. So that's the difference between that. So that's how you calculate it. Now, guys, Sorry. Yes, Rex, you want to say something? You saying something, Rex? No, right? Okay. Now, if employer is a CCPC, okay, no problem. Now, employer is a CCPC. Now, there are different kind of corporations, right? Okay, sorry, I thought it's good. Employer is a public company, so there are different 6 kind of corporation in Canada. Okay, and share can only be issued by the employer who are a qualifying employer. Okay, because share cannot be issued by somebody who is not eligible to do that. So that is generally happened by the corporation. So suppose if employer is a CCPC, where this Canadian controlled private company. Okay, the amount there will be a little bit difference in the timing. Okay, now if it is a public company, when you exercise it, you will consider it as a taxable benefit. But if you are a Canadian controlled private company, in that case, if your employer is the same question. Okay, if your employer is issuing you, or if employer is trying to give you the share, and there will be no effect in the initial granting stage. And even when you exercise it, there will be no effect. The amount as an employment income will only be included in the employment income when you sell the share. So this will that will be same amount, 500 and 500. However, this amount will be included as a taxable benefit only when the employer sell the share. Okay, employee sell the share. Okay, so in this case, there will be a difference between a CCPC and a public company. So if a public company, if an employee says that, okay, I am buying the share, okay, so they will immediately be added up in their T4, in the next T4. But if they say I'm buying the share, there'll be no effect. When they say that I'm selling the share, at that moment in time, you will include it in your T4, $500. So that's something which is very important to be noted between a CCPC and a public company. Have a look at it. Take a couple of minutes and understand what exactly it's trying to say, okay? Also need to understand that there are certain deductions available. If at all you fulfill certain condition, an employee can get certain amount of deductions on issue of share as well. But anyways, have a look at this first. Have a look at it, and then I will be talking about the deductions. Okay, so so there can be an offer by any type of corporation, but if there is an offer by a public company of a share, and if employee accepts that, the effect of employment income will be in the same year when they exercise they purchase the share. However, when employer offer the share, if it is a CCPC, and an employee purchase the share, there will be no impact on the account or on T4 or anything. But when the employee will sell the share, in that year, the amount will be included in the T4. So now there is a deductions. According to section Income Tax Act 110 of 1D, there's a deduction of 1/2 of the employment income inclusion, a deduction from net income to get the taxable income. So there will be a deduction if a person or an employee, as a person who is an employee and who fulfills certain kind of conditions. In that case, there will be a deductions of half of the amount. Now, employee can claim a deductions under paragraph Act if following conditions are met. A qualifying person agreed to sell or issue to the employee share of its capital stock. Employee dealt at arm's length. If the security is the share, is prescribed share, and if it is a unit, and it is a unit of mutual fund, and the price of the share or a unit trust is not less than its fair market value when the agreement was made, there is an additional condition where an employee receives a cash instead of acquiring security. So suppose, for example, all the conditions that he should be a qualifying person. At the same time, this amount is valid, is saying that this amount should not be less than the fair market value. That's the amount. The price of the share or the unit should not be less than the fair market value at the granting time. Now it's equal. So if it is $10 and the fair market value is $5 or $8, in that case, the person would be eligible to receive a deduction of half of the employment income, that is $250. At issue price, it's mentioned as at issue, option price is greater than the market price at the issue, like when the granting. Okay. Now, if it is a CCPC, there are additional conditions to be fulfilled. Like this is all the nitty-gritty, which is from an employer perspective, if you are going to be an employer. Okay. So there are additional thing. If CCPC, if the share is available, is held for 2 years without regards to the option price. Doesn't matter if option price is higher, lower. If it is a Canadian controlled private company, then you have to, corporation, then you have to hold the share for 2 years when you purchase it, and then only you can sell it. In that case, you are eligible for a deduction from a net income, 1/2 of the employment income. Okay. And that will be reported in your income tax return. So Eleanor, if you have the share, try to have a look at the details and try to see if you can file some kind of deductions in your file your deductions in your income tax return if you are selling it, or what is the corporations is offering it. I'm sure you will be able to make some kind of filing in your income tax return. So that's something which is with regards to the stock option. This is just a budget proposal. Yeah. This is the so much of tension from employer perspective. Employer has to go through so many things, guys. So you being an employer, you need to understand it if you are eligible employer as a corporation, yeah, or maybe you know what, any other employer. Employer sponsored social events. Now, if employer provide a free party or other social events to all their employees and the cost is $150 per person or less, then it's not considered to be a taxable benefit. Have an additional cost such as transportation home, taxi fare, and overnight accommodation are not included in the $150. If the cost of the party is greater than $150, the entire amount, including the additional cost, is a taxable benefit. Okay, so the entire amount, suppose the person, if the employer is hosting a party and the amount is $200 per person, then the whole of the $200 will be included as a taxable benefit. But if it is $150, then it's not a taxable benefit and it is not included in the income. Okay. Spouse travel expenses. If a spouse or a common law partner accompanies an employee, like if there is a spouse or a common law partner on your business trip, like suppose for example, if there's a business trip and Rex is going for a business trip to Mexico, okay, well, nobody goes to a business trip to Mexico, but let's put it up there, and his spouse says that, okay, I also want to join, and they go together. So suppose if at all, if a spouse air ticket is also being sponsored by the employer, in that case that amount will be considered as a taxable benefit. However, if the employer says that your spouse can accompany and I'm going to sponsor that ticket, but your spouse is going to help me in the business presentation as well. So if the employer requests to the employee's spouse to help in the presentation or other business activity, in that case, it is not considered as a taxable benefit because it's for the business purpose. Okay. Tax-free saving account. Well, employer may offer their employee and their spouses the opportunity to participate in a group tax-free saving account. So if the contribution is made by the employer to the employee, then tax-free saving account as well as administration fees that the employer pays are all considered to be a taxable benefit for the employee. Okay. However, this does not include amount withheld from employees' remuneration. So contribution made by the employer to the employee's TFSA is generally paid in cash and are taxable, pensionable, and insurable. That means income tax, CPP, and EI is deducted. Okay. However, in terms of administrative fees that is paid directly for an employee are taxable and pensionable, but they are not insurable. That means they are not considered to be included in the EI. Okay. So that's something which is to be noted. Tickets to the event. So whether a ticket is a taxable benefit for the employee depends on whether the ticket is provided for personal or business use. If an event's ticket is provided for the business use, like if there is a ticket is provided where you enter into an event and you do some marketing stuff, or you provide supervising and managing the event. In that case, that is not considered to be a taxable benefit. Okay. However, if you're providing it for the personal purpose, it is considered to be a taxable benefit included in your T4, and EI and CPP is also included. And all this kind of other, all this kind of fringe benefit offered by the employer to the employee will be mentioned. Whatever is like, they don't provide all the benefit, right? Not one employer is going to provide all the benefit to the employee. So whatever is provided will be mentioned in the other information below in the T4 slip. If you remember, we saw the T4 slip. So T4 slip below with the code number and with the item, whatever exactly it is provided, like boarding, lodging, or ticket to event, or and they have a relevant code number, so that will be provided. Okay. Tool reimbursement. If employer reimburse or provide an allowances to their employee to offset the cost of the tools that they need to their job or pay for the tools, the amount of payment is a taxable benefit and is considered to be included in the employment income. When employed trade person, like say for example, there is somebody who is an apprentice mechanic, okay, and they need that tool to do their job, okay. So they can also file they can also file it and claim the amount in that case in the employment from their employment income. So that is something which is to be noted, that they may be able to deduct the past of the cost of the eligible tools they bought to earn employment income as a trade person. Transit passes. So if employer pays for a or provide their employee with public transit passes, it's usually a taxable benefit for employee. Yeah. Public transit include transit by local bus, streetcar, subway, commuter train, and local ferry. Okay. And it's included in the T4. However, if you provide transit passes, but your business is that you are an employee of the transit company itself, in that case, what does it happen? So in that case, if your company is in the business of operating a bus, streetcar, subway, commuter, or a bus or a ferry service, and you provide free transit passes to your employees or their families, so special rules applies. In that case, if you provide, like employer provide free or discounted passes to current or retired employees, well, if you provide free or discounted passes to a member of the employees or a retired family, the fair market value of the passes is taxable benefit. So if you provide, if a company is into the business of this, and if you provide to the employees, there are special rules applies, okay? And that need to be noted, that what are the different rules applies. So if a city owns a transit company and a fair market value of the pass given to the current employee in city's accounting department would be a taxable benefit, while a pass given to current employee in accounting department of a transit business operation would not be a taxable benefit. So depending upon that, where exactly are you working, okay? City's accounting department or accounting department of the transit business operations. So that depends again on whether you will be able to charge or you'll be able to taxable or not. Even if you are an employee has a suppose if you provide free or discounted passes to a current or a retired employee of one of the businesses mentioned above, like the transit or any businesses, the passes are only for the employees or retirees used, and there is no taxable benefit for employee or retirees. So in that case, to qualify as a non-taxable benefit under this special rule, ferry passes are limited to passengers. They have special rules again. Travel allowances. So you may give a part-time employee reasonable allowances or reimbursement for traveling expenses incurred by the employees going to and from a part-time job. If so, and you and the part-time employee are dealing at arm's length, okay, that's you're doing a business, right? So you do not have to include that amount in the employee's income because you are doing the business. She is coming to work. However, this applies to teachers and professors who work part-time in the designated and educational institutions in Canada, providing service to you as a professor or a teacher, and the location is not less than 80 kilometers from the employee's home. Part-time employees who had employment or carried on the business, and they did the duties at a location of no less than 80 kilometers for both the place of employee's home and place of other employment or business. So yeah, However, there are salesperson and clergy. You know, clergy are people who are working in the religious place, you know. So you may pay a reasonable travel allowances for expenses other than use of an automobile to a salesperson or a member. You do not have to include allowances and employees' income because that's a salesperson job, right? Income, if it was an expenses related to performance of the duties, like an agent selling property or negotiating contract or a member of clergy. Uniform and special clothing. Your employee does not receive a taxable benefit if you supply your employee with a distinctive uniform they have to wear while carrying out the employment duties. You provide your employee with protective clothing designed to protect him or her from hazards associated with employment. So if you reimburse or pay an accountable advance to your employee to buy uniform or protective clothing and require receipts to support, the reimbursement or accountable advance is not a taxable benefit. If the cost of uniform or protective clothing is reasonable, if the employee has to wear the protective clothing on the site where they're working, if you pay an allowance to the employee for the cost of protective clothing and did not require receipt to support the purchases, the allowances is not a taxable benefit by law. Okay. You may also provide some laundry services or dry cleaning services to clean the uniform and protective clothing for employee. They are also not a taxable benefit. So that's a part of the work and they are not considered to be the part of the taxable benefit. So we always change the uniform every month. Oh, okay. So that's our uniform and Superstore is just sponsors by different companies. Okay. So they are also the uniform, but yeah. So they are not considered as a taxable because that's a part of your employment and you have to wear in the employment. So that's not like a special, thanks Eleanor. So that's not like a special thing that is offered to you. And in that case, it's not included in your taxable benefit or income. So they are guys, we talked about like pretty much many, each has their own rules and regulations, but they are including the taxable benefit. If any of thing is like you are getting it, try to have a look at it, what exactly. Eleanor is getting like pretty much some stuff. So if you're getting some kind of benefits, try to find out they're included in your taxable benefit, in your taxable income or not, or the employment income or not. So you can try to see how much it is deducted. No wonder if it's included, you anyways get some kind of CPP and EI. So that's not a sad part or not a bad part. But now you need to depends upon what exactly is included. Okay. Now when we were talking, yeah, employer supplied automobile, standby charge operating allowances. Now guys, there's a difference between allowances and reimbursement. Allowances is a fixed amount paid to cover some type of cost. Okay. While in case of reimbursement is like once you incur the cost, you give the receipt. So that's the actual cost and the employer will pay you accordingly, the reimbursement. So allowances are added up, can be added up into the taxable income or it cannot be added up. Okay. While reimbursement is not an employment income. They are just deducted. Employee cannot deduct the actual cost. So that's like you can also not include, you cannot claim for the CPP or EI because it's not added up in the employment income. However, there are allowances who are taxable and non-taxable. So if you see, allowances is a fixed amount, okay, which is paid by the employer to the employee. And they don't ask that where did you spend, where did you not spend. That's okay, you know what? But they are added up in the employment income, okay? However, if you have a reimbursement, they ask you everything. Okay, I had a meal. So how much did I pay for the meal? So you just show the receipts. And so that's called the reimbursement. There can be certain amount of allowances as well, but there's a difference between allowance and the meal. Okay. Allowances can be taxable and it cannot be taxable. If it's not taxable, it has to be reasonable. As we said, automobile allowances, which employer gives it to their employee. So they are not added up in the tax for the tax purposes because they are considered to be reasonable. So they offer like 0.5 cents for first 5,000 kilometers and then 0.52 for each additional kilometers. Employer's perspective, paying taxable allowances is easy. No need for keeping individual employee mileage record. You just have to pay the taxable. You pay in advance or you pay the allowances and you add up that amount. From employee's perspective, receiving non-taxable allowance is easiest because you don't have to keep the record of it, anything, okay? If it's an allowances, you have to keep a record of it, right? So yeah. May or may not be beneficial depending on the relationship between the allowances and actual cost. Insurance benefit, we talked about it, the private and the provincial. There's a disability insurance as well, which is offered by the employer, and which is premium is paid by the employee, not deductible when paid. Benefit received, employer makes contribution taxable, employer does not make contribution not taxable. It can be offset by the deductive cumulative. That happens in the disability insurance. Loans, we talked about the loans as well. Home purchase loans, stock options, deductions, stock options, other inclusions. We also talked about payment by the employer to employee, forgiveness of the employee loan. I was talking about it. Even housing loan reimbursement. So housing loan reimbursement is also a kind of, as we said, that they have housing loss reimbursement is also kind where they're included in the, with as a reimbursement, they're included in the taxable benefit. Discount on employees' merchandise are tax-free again on a specific, but then if it is other situations, they are taxable benefit. Now, there are certain deductions, okay, which we'll be discussing after the lunch break. Now, these are the deductions. Till now, when we were talking about it, we were just discussing about what an employer can add up to your employment income, and what they are added up to the employment income, they will be considered to be a taxable benefit, and there where EI and CPP will be deducted. However, now when we are going to talk about the deductions, this is something which you can claim when you are spending the money, okay? So this is, we'll be discussing it after the lunch break. So these are the amount which will be deducted from your, if you incur the expenses, and you can claim for this amount. But previously what we discussed, it's not something which you are claiming it, which employer is adding up in your T4, and which will be shown in your T4. So that is the amount which you can include it in the income tax return, okay? Income tax return document. Well, I can do one thing now. I can email you all the income tax forms. There are heaps of forms, so don't get overwhelmed by that form. It's okay. We will be using it tomorrow for that. Not too much discussion, but it's like your you can look at, if you have a printer, just print that form. One, it has one form of 8 pages, and there are many schedules. So from this year, 2019, there is a change in the form. The new form for the personal return, for the individual personal return is come. Up until 2018, there was an old form used, but there are not major changes. They have just made some changes to make it much more easier for the people to file the tax, and they have increased they have made the changes. I'll show you when we are going to do it. They have made the changes with the numbering line. Like they were using 3 digits, now they're using 5 digits. Okay. So I'm going to email that forms to you. So in that case, this I'll just keep it on hanging, and we'll be discussing it this after we come from the break. Okay. And then we'll do the problem of automobile as well. So meanwhile, I can send you the forms. Okay. Have a look at the form. That is not for this chapter. This will be for chapter 4, but I wanted you to have a look at the form so that you can see that what exactly are you filling it when you are filing the tax return. Okay, I'm not going to send you detailed provincial one, but mainly federal one at this moment. Okay, one more thing, guys. I'm going to send you a new Zoom password and ID in some time as an email, because the number of days where you can use the password and ID was 20 days or more since last time. I think more than 1 month. I think I've changed it, right? But now, because there are no more, the meetings cannot be scheduled on the same old password and ID. So I will be emailing you. So from tomorrow onwards, just don't get confused, but use that new password and ID to get into Zoom. Okay. I repeat it once again. Do not get confused. I'm sending you new password and ID now in a couple of, after I send you an email. So you can use that password and ID for your from meeting from tomorrow onwards, because all that password and ID what we have used it, now from tomorrow onwards it's expired. So I cannot use that older one anymore. Also, just to let you know, guys, that you will have an assignment which you have to submit it by next weekend. So I will send you the assignment questions tomorrow on Google Form. Your class quiz, I will decide whether you can do it tomorrow or not. Don't worry about the class test tomorrow. Like I might not. Okay. But you will have an assignment of 30 marks. And final exam will be on the last day. Now I'm not sure whether when we finish the module, like on on 16th and 17th will be our last day of the module, right? 17th. But because 18th is a Victoria Day, I'm not sure 17th is a holiday or not. So if it is a holiday, then we'll conduct the final exam. I'll tell you the dates of the final exam accordingly, okay?